Mengulasnya bersama dengan Chairman and Managing Members of Great Hills Capital, Thomas J. Hayes, bergabung dari New York, Amerika Serikat. Good morning from New York, Thomas.
Good morning, Safrina. Nice to speak with you again.
A pleasure to have you in Closing Bell CNBC Indonesia. So, Thomas, the Fed finally approves hike that takes interest rate to highest level in more than 22 years since 2001. What's your take on this?
Well, I think the big takeaway that is kind of a headline catcher here is that the Fed is done and they just don't know it yet. So between now and the September meeting, we're going to see two more inflation prints, which are going to be very important, as well as two more job reports. And if you look at the most recent data, they actually had enough data to give them cover. If they wanted to skip or pause in July, they certainly could have. But the market priced in one more hike, and they went ahead with that hike. Looking back at the PPI, came in near deflationary levels. That's the wholesale prices, which precedes the retail prices. That came in at 0.1% year on year. And our CPI, as you know, came in at 3%, just a tick above a two handle. As well as the jobs report, the most recent jobs report, we had 209,000 non-farm payrolls, which was the lowest job creation in 19 months. So all the data is there, Safrina, for the Fed to skip again or pause in September. But what's important to understand is they can't just skip and say, okay, let the market go wild. They have to continue to talk hawkish to keep inflation expectations lower so that people's behaviors don't change. And that's where they're succeeding with 5-year inflation break-evens right now at 2.24%. They're basically at target.
They had to continue to even keep talking hawkish to maintain the inflation expectation to be around 2%. And how about the inflation target this year? What do you think? Is it going to reach the 2% finally at the end of 2023? In your opinion, Thomas?
I think we will see a headline inflation print with a two handle, probably high twos, but that's a fantasy. I think really we have 120% debt to GDP. The last time we had debt to GDP this high was after World War II in 1948. And what they did to get rid of the high debt to GDP is they ran inflation between 3 to 5% for 5 years. And they inflated it away from 120% debt to GDP down to 63%. So I think they need to run inflation a little bit above trend to bring down our debt to GDP ratio. You know, ordinarily what you would see is when the Fed funds rate exceeds the inflation rate, and their preferred measure of inflation is core PCE. We're going to see that on Friday. It's expected to come in 4.2%. With the Fed funds rate at 5.25 to 5.5, they should absolutely be done.
Right, Thomas. And still on the interest rate, the markets and the policymakers has indicated at the June meeting that the 2 rate hikes are coming this year. And markets are pricing in a better than even chances that there won't be any more moves until this year. What's your take on this? Any more move from the hikes of the Fed fund rate still coming up until 2023?
I think they're done, Safrina. I think this is it. I think now you're going to have a massive tailwind and a massive amount of foreign investment start to happen. Emerging markets are going to be the beneficiary of the Fed being done. And I think the theme moving forward is that the dollar is going to continue to weaken, which is ordinarily highly correlated with emerging market inflows and emerging market equity rallies.
Right. And how will actually the increase in this interest rates, which have been very, very aggressive since March 2022, finally affect the Southeast Asian economy and probably the whole world?
Well, the U.S. was first in and they're going to be first out. So they were kind of first to start the aggressive hiking policy. And now we believe they're 100% done. I mean, the risk that they have on the table, looking at the most recent PPI print, is deflation, not inflation. So with that said, once the Fed is done historically and the dollar continues to weaken, you're going to see massive flows into emerging market equities. And I would put this, Safrina, very much like the rally from 2002 to 2007, you had a very strong US dollar into 2000, 2001, and then it started to roll over, just like we've seen since October in anticipation of the Fed being done. It softened. It had a little rebound in May due to the debt ceiling negotiations, and it's resumed its downtrend. If you look back at 2001, when that descent started for the US dollar, the weakness, it set the stage for what was the largest equity rally in emerging markets in history from 2002 to 2007. I think we're going to see a similar type of scenario as we look out for the next 3, 4, 5 years. Right. With a weaker dollar, emerging market equities and economies are truly going to flourish.
We also hear some interesting opinions that it is time for the Fed to give the economy time to absorb the impact of a past rate hikes, which have been very, very aggressive for this past 1 year. What's your take on it? How is the final scenario going to happen? Is it a soft landing one, the hard landing one, or what's going to happen?
Well, I think it can be a soft landing. I think the Fed is done. So basically, looking at the data, seeing the data between now and September, they will never acknowledge that they're done. I think what you're going to see is the data is going to continue to support them pausing. They're going to say, look, we reserve the right to come back in the market and add new hikes just to tamp down the long-term inflation expectations. But we think all of their tightening is now in the rearview mirror, and that sets the stage for positive growth moving ahead. The other thing we have to keep in mind, and I think they're cognizant of and a little bit worried about, is we passed a tremendous amount of fiscal stimulus in the United States infrastructure build with the Inflation Reduction Act, and much of that money is just starting to hit the market over the next 12 to 24 months. So it's going to be positive for growth. But I think the Fed is reserving the right to stay restrictive just in case all of that money hitting the economy leads to some type of short-term resurgence in inflation, which we expect that it won't based on the trend of the inflation numbers. But I think they want to reserve that right to tamp it down because that's a lot of money that's going to hit the economy. Yeah. It'll be good for the economy. It'll be good for jobs, but we have to keep an eye on inflation.
Yeah, for sure. And what is the relation between the Fed's interest rate policy and also the inflation in the United States and its impact on the international trade in the U.S. itself?
Yeah, well, they've collapsed inflation. Headline inflation's dropped from 9.1% just over a year ago to 3%, and we'll start to see high two handles in the coming months due to owner's equivalent rent and high base effects, et cetera. So with a strong dollar, which we've had in recent years, it's really incentivized us to be massive importers. And I think going forward, we're going to see more export, more domestic investment, et cetera. And it changes the theme. The other thing the theme that changes is I think the outperformance for equity markets and investable dollars in the U.S. are going to start to go to emerging markets because that's where you're going to see the massive growth with the weakening dollar in the next 3 to 5 years. So I think there are massive tailwinds. I think the emerging markets are going to be the major beneficiary, including Indonesia.
Hopefully, Thomas. And now moving on to the markets, some curiosity about the markets, especially in the U.S. The Q2 2022 earnings season is almost upon us in the United States. And, we see some macroeconomic headwinds remaining fairly strong in many markets. What's your take on this? Is it a good sign for U.S. markets and also global markets, Thomas?
Yeah, so we're in Q2 earnings season right now in the United States. And like we always say, the secret to happiness, whether it's in life or in markets, is low expectations. And we came into the Q2 earnings season expecting negative 7.1% earnings growth. And what we're starting to see is better guidance than expected, mostly better earnings than expected. And we'll see, I think, improvement throughout the earnings season. On average, it improves about 5.3%. So with that said, we could go from a negative 7% expectations to potentially finishing out negative 2 or 3% like Q1. And that would exceed expectations, which would force analysts to take their numbers up for the back half of the year. And I think based on institutional positioning, I think you're going to see a huge catch-up trade chasing stocks that haven't performed into year end.
Does this good sentiments that the Q2 2023 earnings season will also brings to the U.S. market will also having a good contagious effect to Southeast Asia's economy or emerging countries and emerging markets like Indonesia? Your take on this, Thomas?
Yeah, no question about it. And I think the other theme that very few people are paying attention to for the second half of the year is with the weakening dollar since last October, we're going to start to see that hit U.S. multinationals, particularly those that get more than 50% of their revenues abroad, hit their earnings positively in the second half of the year, which is not baked into most models at this point. And I think those earnings beats are going to be very positive for the U.S. markets. It's going to be very positive for emerging market flows and a tailwind for the global economy. So I know there's been chronic pessimism. We haven't participated in it. We were actually on your show in October, November, pounding the table to buy stocks when everyone was selling them, saying we would go lower. But we think that we're in a constructive period. In the U.S., we don't anticipate we're going to replicate the returns that we had in the first half. In the second half, in terms of the general indices being up 18% year to date. But even if we got mid-single digits to maybe high single digits, the money's not going to be made chasing the indices at these levels. We believe the money is going to be made under the surface, starting to rotate in those areas that haven't performed in the first half. Most importantly, emerging markets in China is going to outperform in the second half, we aggressively believe, as well as multinationals that get much of their revenues from abroad.
Now, we're also moving on to some international trade issue. We currently see about the trade wars going on between U.S. and China. What is the impact of these trade wars and other trade conflicts on the economic growth for both United States and also the global economy? Because as we've seen here, we have some opinion about America's love of trade sanction will be its own downfall. What's your take, Thomas?
Well, number one, I would never bet against America, so I wouldn't worry about America's downfall. However, I think policymakers need to be responsible that we are more interdependent than ever, and posturing on a one-way, hard-in stance doesn't serve anyone. It doesn't serve the U.S. It doesn't serve the international countries. What I will say is I do believe we've hit peak trade war, and it's starting to de-escalate. Whether you've seen Janet Yellen go to visit, Jamie Dimon go to visit, all the business leaders, all the political leaders, John Kerry, Yellen, et cetera, starting to go over. The key is that Blinken visiting several weeks ago, the key is dialogue has begun, negotiations have been begun. Both sides are starting to dial things down a little bit, and I think that's a huge positive for the United States. I think it's a huge positive for China, and I think it's huge positive for the global economy.
And we hopefully seeing better things coming up until 2024. And furthermore, what are actually the main challenges faced by emerging markets like Indonesia and other Southeast Asian countries in achieving sustainable economic growth despite so many uncertainties in global economy?
Well, you not only have the currency tailwinds, you have the demographic tailwinds. Much of the emerging markets has a young, educated, vibrant population, which is the key component in the formula to financial and economic success. So the key is the tailwinds are in your favor, the currency tailwinds are in your favor. Just don't screw it up with bad policies, is my best advice to Southeast Asia. As long as you keep your economies open, as long as you keep going with investment, allowing foreign investment, doing friendly trade policies, working together, I think that the future for the next 3 to 5 years in terms of outperformance of equities is going to belong to emerging markets, including Indonesia, which has one of the best demographics in the region, has a democratic government, and very positive things happening, natural resources, all the components you want to see in a growth story over the next 3 to 5 years.
Thank you for that, Thomas. And lastly, a brief update about the debt situation in the United States, which have been a really great issue for the previous 2 months. How is it going, Thomas?
Well, they're going to have to inflate it away. So as much as
Right.
Powell continues to talk about 2%, I think they've got to let inflation run above 3%, 3.5% for the next handful of years. That'll bring our debt to GDP down, debt to GDP ratio down. It will make the interest servicing more acceptable, and we'll get back to long-term strong growth that we've experienced for over 200 years. So we've been here before. The key is to do the right policies, not to get too tight over at the Fed, and it'll take care of itself in coming years with growth and with increased standard of living. So we're very sanguine on the outlook for that situation.
Truly wishing for the best for the United States, as what happened in the United States will also impact the whole world. Thank you so much for having your time with us in this discussion with Closing Bell CNBC Indonesia. Thomas, always a pleasure to have you with us. Thank you.
Thank you, Sabrina. I appreciate it.